Welcome to the Voice of Insurance. I'm Mark Gagan. One of the most eye-catching parts of the Lloyd's of London blueprint reforms has been the Syndicate in a Box initiative. The idea of a fast-track, light-touch, low-cost, fast-fail syndicate has gone down really well with the market. This is because, over the past 2 decades, many players have bemoaned the steadily increasing cost of starting a new Lloyd's business and have wondered where the next generation of new Hiscoxes, Kilns, Catlins and Beazleys might come from, given that barriers to entry are now prohibitively high. The received wisdom over that time has been that MGAs had become the go-to place for entrepreneurial underwriters to go and prove their mettle. So the Syndicate in a Box initiative was well received. The only trouble was that many in the market were a little confused about what the new structures can and cannot do. And that is why I tracked down this episode's guest. As the active underwriter of the first and currently only Syndicate in a Box, Stuart Newcombe of Munich Re Innovation Syndicate 1840 is uniquely positioned to enlighten us on this exciting new departure for the Lloyd's community. Stuart is an engaging and personable character with over 30 years' experience in the market. I really enjoyed chatting with him and exploding some of the myths around the new structures. But what I liked more was hearing all about what the Syndicate is up to. This includes guarantee products for solar panels and energy-saving schemes, ideas to ensure the gig economy and autonomous vehicles, as well as lots of interesting angles on the use of parametric insurance to fill in the gaps left by traditional indemnity cover. I think you'll enjoy it too. I started by asking Stuart to make a brief introduction by running quickly through his career to date. Before we get started, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry.
I started in 1990. The majority of my career has been focused on personal accident and related special risks. So a lot of professional sports insurance, the higher risk occupations of journalists in war zones, private security contractors, things like that. In about 2012, I made a move over from underwriting at the box to working more on the underwriting development, focusing on new business lines, bringing in new products, bringing on board new teams. And I was running that role when the Syndicate in a Box opportunity came through for us to work on. So I started running it as a project and ended up taking ownership of it.
So you've always been working on the innovation side of things, if you're bringing in new business and doing quite sort of innovative classes of business before you even started doing that anyway. So, but how did you manage to get involved in this, and what was it like, and how long did it take?
It was very, very fast. I came back from a business trip on the 3rd week of July and was sort of asked, would I mind picking up this project that colleagues in Munich had kicked off while I was away? And that was the start of Syndicate in a Box. I took it over because, European holiday season is in August. So an awful lot of them went away on holiday then. And we needed to have it approved by about the middle of September to enable the Blueprint 1 announcement to go firm and say, we have a first Syndicate in a Box. So it was extremely fast.
So you sort of drew the short straw, is that right?
No, perfect. For me, it was really interesting and it was really very exciting. It wasn't a case of, okay, here's a team looking to move from another syndicate. Let's check their plan. Let's check their numbers. This was genuinely new and exciting. And we were working very closely with Lloyd's as well, which was a very good experience. Rather than just, sitting outside analysing what somebody's presenting to you, it really was a build.
So in terms of this process, you've spent a lot of time, a lot of your career dealing with Lloyd's, and maybe, if you're trying to bring on a new business line, obviously, annual syndicate business plan approvals and that kind of stuff. So how did this process differ from that experience that you've had for many years?
It was very much about the speed and the flexibility. There was a real desire from Lloyd's that this would work. And they didn't want to be talking about it for years. And so there was a very open dialogue throughout with expectations. And I've described it before as it felt like they were laying the bricks about 2 steps ahead of where we were walking. It was that live. And they put together a making it happen team from people within the the corporation, and we were in very regular contact with them to say, okay, we think it might look like this. Have a conversation, go back, refine it. So as opposed to the usual submit and wait 6-8 weeks for a response back, it was all being done virtual real time. So very, very different speed.
So I suppose it's partly because you're sort of having the red carpet sort of rolled out for you. Do you think it would be the same for everybody who's going to be going through this kind of process?
I would say broadly, yes. The desire is to build a syndicate in a box very quickly. That's the whole point. It is quick to build and ultimately, if unsuccessful, quick to fail. We're hoping it doesn't fail. We hope that they're successful across the piece, but it is about building quickly because it is a very different structure. The syndicates are smaller, they're lighter, they have a shorter tail business focus, a non-catastrophe business focus. So there is an element that we can view them slightly differently than we would a traditional big Lloyd syndicate, which could have longer tail, more cat focused business.
Yeah, so let's really get down to the actual definition for the benefit of listeners. You are the active underwriter for the syndicate, the only syndicate in a box that's currently in existence. So what is a syndicate in a box as opposed to a normal syndicate? I mean, you've mentioned some of the elements there.
Some of the characteristics, yeah. So Munich Re-Innovation Syndicate 1840 is the first one. I genuinely hope it's the first of several. A syndicate in a box is part of the Lloyd's blueprint, the future of Lloyd's, and it's specifically designed to allow smaller scale, more innovative businesses to access Lloyd's, perhaps in their own right, where previously they may have come through as an MGA or some other partnership, maybe using a fronting carrier or something else. They can actually back their own underwriting. It has to be small. And by small, I mean less than 100 million of income on the plan. And as I just mentioned, shorter tail, non-catastrophe. Not exclusively, but it's got to be focused much more towards the short tail because it is a fast build, fast fail type environment. It must focus on bringing new business to the market. It can't sit there and just churn existing classes of property, casualty, general aviation, whatever. It's got to be bringing value to Lloyd's. The exchange for that is that they get a slightly lighter touch as they go. It has to have a non-traditional structure, if you will. We're not allowed to have a box in the underwriting room at Lloyd's. And that contributes to the other part of being a syndicate in a box, which is that it must have a lower operating cost than a conventional syndicate. So it is very much about different ways of working rather than copy-paste traditional Lloyd's syndicate structure. You've got to do things differently.
And with you, in terms of light numbers of boots on the ground, I mean, how many people are you in Syndicate 1840?
Syndicate 1840 on the ground has the grand total of 3, with a 4th being recruited. That is myself, the other underwriter. We have a dedicated actuary for pricing and modelling, and we're recruiting a dedicated finance and reporting person. So that's it. The sum total in London will be 4 people. But what we do have the ability to is leverage expertise globally within Munich Re, which is why we built it this way.
And you mentioned about the fast fail. So correct me if I'm wrong now. If you can go into what is the fail element of this? I mean, how do you have to have a kind of pre-packaged plan for failure or for runoff? Don't you? Is that correct?
Absolutely. Within part of our SBF and our business planning, we have a clear statement of what would happen in the event that the 1840 syndicate ceases to trade. That's a strict requirement from Lloyd's. Any future syndicates in a box will have the same structure. We were lucky in as much as we part of an established and very successful managing agency. So with board approval, we could say, if this doesn't carry on, we can look to the parent, and the main syndicate 457, can take on that reinsurance to close. I think it's going to be a different set of challenges for those who don't form in that structure.
Yeah, yes, that does seem fair enough, because sitting as part of the Munich Re group, you come in with a huge amount of credibility to say that it's fine. The Munich Re group will make good, and it's not going to be a problem for the central fund. If you're genuinely lightly capitalized fledgling startup, how do you think they might get around that problem? Do you think some of the runoff syndicates might be able to sort of pre-package with them and kind of go in the plan with them to start with, if you have a sort of a Riverstone or someone sort of behind you? Do you think that might be the way of working it?
I think it makes sense to me. I don't have an inside track, But if you're a true startup coming in that don't have an established managing agency to partner with, you're likely to go to one of the turnkey managing agencies, and they're going to help you with that process. And yeah, the run-off syndicates, the other reinsurance to close structures that are out there make obvious sense. It'll probably just take a little bit more work and effort and a little bit more complexity than it did for us. But it's not insurmountable. It's just a different structure.
Obviously, Lloyd's was very keen to have a first syndicate in a box to be able to announce on the day of the blueprint on the at the end of September, the beginning of October, and that big reveal that happened when the blueprint was being unveiled to the public. But other than sort of that being wanting to be a good sort of Lloyd's citizen, what's the real rationale for Munich Re Group to setting up Syndicate 1840?
Truly, it's about having the best of both worlds. We're being greedy with it, frankly, in a good way. Munich Re's got a massive amount of expertise and resources around the innovation space, data capture, data modeling, data analysts, actuarial support. They've got a huge amount of intellectual capacity to build these new types of products. But they are primarily a reinsurance-focused operation with very specific primary insurance areas. So they've got great expertise, but perhaps distribution that isn't quite on the same level yet. Lloyd's has got the obvious advantage of a great primary license structure globally, and with the international infrastructure of Lloyd's to support that, and the distribution power of the Lloyd's broker network and everything they bring to the table. So we looked at it and said, this is a great way to take the best of what we have, the best of what Lloyd's has to offer, and combine the two and try and build something better. And as I said, leveraging everything that's already out there within those respective companies without having to buy or build again and raise the expense cost.
Right, and so what sort of things are you doing that you're bringing to the Munich Re Group that it couldn't already do on its own? Obviously, you do mention you've got all those you've got fantastic resources, and then and even another one that you didn't mention was Munich Re Digital Partners, of course, which is a really big deal in insurtech. You sort of got fingers in every pie. So what's really special about this part of it? Is it really the licensing is that the main thing?
No, that's the enabler. The Lloyd's innovation community, the network, is significant and growing, and we're fully engaged in that. So I'm been involved in several of the Lloyd's lab cohorts, as have my colleagues. We're fundamentally involved, right from the start with the product innovation facility at Lloyd's, and then there's also the Lloyd's broking community who they're always looking for new solutions, new offers for their clients. So when we actually designed Syndicate in a Box, the early thought was that this would be business flow from Munich Re to the Munich Re syndicates, innovation syndicates, to support their licensing issues. That is certainly still there, and it's certainly still ongoing. But we're seeing an accelerated version of what we thought was a longer term issue, which was that we would have Lloyd's brokers bringing their clients' problems to us to try and find a solution within the Munich Re Group. That literally started on day one. In fact, we had inquiries before we were even approved to underwrite. So we've got a real two-way flow of not just requests for business, but some really innovative thinking, which is leading to some really good discussions with brokers and MGAs coming in with some very interesting alternatives. So it is definitely a two-way street.
I'd like to ask you also how, now you're nearly into your first full quarter of trading, how's the actual experience of nearly 3 months of trading borne out against your plan?
It's a very interesting path we're treading at the moment. We are on track. I would say we're perhaps a little slower than we wanted to be to get out of the blocks at the start of the year. Stupid things, the amount of time it takes to get Lloyd's Citus trust funds banking accounts set up we took much longer than we thought. Lloyd's were quicker than the banking community. So it took us a little longer to actually be running than we wanted. We have written our first risks. The first risk was a very nice parametric risk for a windstorm in the Caribbean, exactly in the sweet spot. The pipeline is there and building. So yeah, I'm confident we're on track. When we built the plan, we knew that it was a snapshot taken over a 6-week window. And this is another example of that Lloyd's flexibility, that they sort of said, okay, fine, here's the best effort we have now. It's the best snapshot we can do. Now go away and test it, and we'll adjust it if we need to. And that's what we're doing at the moment. The core elements are still there. We are seeing and well down the road with either launching or selling the key products we hope to do. I'd say we're a few weeks behind where we hope to be, but it's not insurmountable.
Oh, brilliant. Well, why don't you just run through what those key products are? So you're saying parametric. Is it sort of all parametric stuff, or are there any other things that people might recognise as being more conventional but just done in a slightly different way? Or anyway, just fill me in on what is in that plan, and also perhaps anything that's coming new now that all the brokers are coming to you with their problem.
Absolutely. The plan broke into three key areas. We were focusing on green energy, parametrics, and a grouping that we've called emerging risks. The green energy, we were looking at a photovoltaic product as our first one across the line. Munich Re have been writing photovoltaic protection products for some time now, but they're focused very much at the high end of the value scale. So we're working with them to bring that down into a more affordable sector.
So those things are things that I've read of over the years from Munich Re would be things like guaranteeing the efficacy or the power output of those units, so that then the bankers, so over long periods of time, sort of like even 15 to 20 years, so that then the bankers can lend the money against the project without having to worry about whether the product is going to perform, or because the previous worry might be that the solar panels might stop working after a certain amount of time and not be able to produce the power that they need to make the income to pay the loan back.
Yeah, that's exactly what we're looking at. We're not looking at all risks of physical loss or damage. There are established markets out there that cover those very well.
It's like a kind of product guarantee type thing, isn't it? I suppose.
It's a sort of warranty. It's a warranty backup. We actually underwrite the manufacturer rather than the person buying the insurance. We're looking at the quality of their engineering, which again is the technical aspect that Munich Re are bringing, and we're looking at their financial stability. And what we're offering is effectively a warranty backup designed to build confidence in investing in that solar energy. Because if they buy their solar panels and they buy the backup product, then if there comes a time when their output performance is lower than an acceptable level, they would expect to turn to the manufacturer for remedy. If the manufacturer is no longer in business and therefore can't honour their warranty requirements, then we would then step in and honour those on their behalf. So it provides that degree of comfort to the people who are investing in our target market, somewhere between 1 and 5 million euros of value into a solar farm, which is a mid-sized solar farm, to say actually you can invest with some more confidence and be certain that you'll get some return in the event that the equipment fails to function as promised and the manufacturer is unable to support their promises.
Oh right, okay. So it's warranty backup, but does the manufacturer chip in at all to sort of help subsidise the cost? Because obviously it must be very good for them, for their sales team, to say, hey, buy our solar panels because don't take our word for it. We've got guarantees.
There's different ways that they structure it and they sell it, and it depends on the complexity of the deal. This is very much sold and priced as a protection to the investor, and either the investor can buy it in their own right, or the manufacturer could, in theory, contribute to it to build that comfort level.
Right, and no, just to be really clear, actually, who's buying it? So who's paying the premium?
It can be either way. So the manufacturer could, in theory, pay for it and then hand over the policy. In the way that you could assign some other types of policy. He can assign the interest with the panels, or somebody can buy it in their own right. As long as there's that element of insurable interest that we're tracking down, it can go either way.
What else are you up to, Stuart?
On the energy side, there's a clear need to actually just reduce consumption, because what you don't consume, you don't then have to generate, and therefore fewer carbon emissions, or even frankly the need for fewer solar panel farms or wind farms or aqua parks. So we're looking at one which is related to energy efficiency insurance, whereby again people are investing to make their companies, schools, hospitals more energy efficient. And what this does is it allows them to, again, invest with confidence, to buy that equipment, have it fitted. They should expect to see reductions in energy consumption. And if they don't, well, then we can come back and reimburse them for a proportion of those unrealized savings, because they have priced their return on investment accordingly. So it's a combined product. It covers some machinery breakdown, but particularly it covers the failure to generate the savings that are expected.
Wow. And is that, again, a bit like the solar panel? Is that based on the efficacy of the solution, or is there some sort of, is that partially E&O and sort of design risk in there, in that as well? Is it they you might say if you install this, you'll reduce your power bill by 30%, but what if it just doesn't, and it's still performing as it was designed? It's just the way the engineer calculated it was wrong, or anyway. So what specifically is covered?
It's a three-part product. So you've got a breakdown of the equipment. There's an element of a simple business interruption. And then the third part is this energy efficiency. And the underwriting there is key, because the underwriting is focused on the exact point you just raised, which is the design specification of the energy engineers will state what is going to be fitted and what they're expecting to see as a saving from it. And there is an element of having to be careful that we don't double account. You can't save the same electricity 2 or even 3 times. So very much the underwriting review is about making sure that suitable allowance has been made for that factor, and that the expectations seem reasonable. A solar panel can only do so much. Improving the efficiency of your air conditioning units can only do so much. And so there's a technical specialist piece that sits behind that analyzes that engineering assessment and says, yes, that seems fair and reasonable. And once we say that's fair and reasonable, then that's what we're responding to in the event that it fails to meet its expectations.
That's really interesting. Really interesting. What else are you up to?
If we move on to parametrics, which is probably the headline grabber, although parametrics have been around for really quite a while in various shapes and forms. The core with a parametric is that we have access to independent, third-party, verifiable data that is reliable and can be trusted by not only us, but also by the people buying the product. The one we've sold so far is a wind speed in the Caribbean, which obviously is very well monitored and very well served with weather monitoring. But some others, we're looking at a hail using a proprietary hail sensor, so a solid state sensor. We're looking at some for rainfall, for river height, anywhere where there is a clear correlation between a set of factors, the parameters, be they the height of the river, the amount of rain that's fallen, with a reasonable expectation of financial loss from the insured party. So what's referred to as basis risk. We've got to make sure that there is a suitable proxy relationship between the event and the loss. And the better the data, the better you can manage that risk for the benefit of both parties.
Yeah, because for listeners who are not really au fait with all this is the risk that that you have a loss, but the insurance doesn't pay because the parameter was set sort of wrongly, or the other slightly odd one is where you end up having a kind of insurance profit, but where you didn't have a loss, but where the parameter was hit, but you didn't actually have a loss because they weren't properly correlated with each other. How are you deploying them that's slightly different from other parametric insurances?
Yeah, we're seeing a real move from parametrics as a well-established part of, say, the reinsurance industry, and purchased by large corporate buyers who are very risk savvy. They've got very sophisticated risk buying techniques. Where we're seeing greater and greater interest on parametrics is moving down that value chain, down towards SMEs and even sort of retail consumers in some areas. It's not one we backed, but for those who want to look at it, Flood Flash in the recent UK floods was a fantastic example of a parametric in action at the lowest level for consumers. They were getting their money really quickly, and that's the key sell for the SME and down to the retail level, is that speed of flow of cash at the time when they need it the most, and that's what a parametric can really deliver.
Flood Flash was one I was going to mention to you, and it's for listeners, it's definitely worth checking out what they've been doing and what's happened in the UK. I'm sure they'll be doing a lot of publicity around what happened in the recent winter UK floods. What are the other main applications? I remember you mentioned something about perhaps open car lot for hail. That was quite interesting. It would be worth sort of explaining to listeners about that.
Yeah, that's one we're still working to develop or to finalise. I'm hoping we're going to go live with it very, very soon. For those who've been involved with the cargo market, the the story of dealers open lot, as it is called, which is damage to cars in the open, has not been a pretty one. And hail particularly has caused a problem with damage to metalwork, paintwork, windscreens, in some cases totally destroying the cars to the point they're a write-off. So the conventional insurance industry has reacted quite reasonably and put increased deductibles on, and the rates have gone up because of that historic loss record. So what we're offering is hoping to go through soon is a product that's based around hail size, and it is it's a very low limit compared to the total value of stock, but it is enough to take the sting out of either the deductibles they're carrying on their conventional insurance policies, or frankly, again, just to support cash flow. If your business model is predicated on selling 4 cards a week for a large dealer in the US, and suddenly you can't for the next 2 or 3 weeks until they've been adequately surveyed by your conventional insurance adjusters, and then the payment is made, you're sat on a cash deficit for a fast flow business, and they could use that parametric payout to make sure they pay their staff, quite simply.
Because you could lose your staff to because some of these hailstorms are really localized, aren't they? And you could lose your staff to another lot down the road. And if you've got a lot of people, I presume a lot of those salespeople are working on commission only, almost, and if you don't pay them some kind of retention bonus, they might move on, and then you've got a real problem.
That's certainly part of it, and I think also for those who want to just keep their good staff, it's just a very attractive option to be able to guarantee them that they're going to be paid in the event that hailstorm comes through, that they can keep the people they want, and frankly treat their staff well. There's a moral aspect there that they could actually go around and guarantee to pay them, which is a good thing to have. We're seeing that there's other things around filling the gap, because a lot of this parametric is about filling the gap of conventional insurance.
I was just going to ask you to clarify that, because it's not really, so it's not an either or, it's really, you're saying it's something that's filling in where traditional insurance is a bit slow or failing, or there's just little gaps here and there, rather than something that's going to completely replace traditional insurance.
I don't believe that parametric insurance will ever entirely replace the traditional indemnity insurance programs. It's built to do different things, and it's priced very differently. What it does do is give that rapid cash flow, the rapid flow of money, and as I said, covering the gaps. That could be deductibles, which if you're in a complex claim situation, whilst each policy may have a perfectly fair and reasonable deductible, if you're stacking a few of them because of different insurance policies for different areas of your business, suddenly you're looking at quite a deficit. You've got other things that wouldn't necessarily be claimable under a business interruption or physical loss or damage policy. Your staff may just become more expensive because market economics after a major event says they can need more money for their work because labour is in short supply, for example. So what we see people doing is buying it to try and smooth that part and say, okay, I've done everything possible now to minimise things falling through the gaps.
Yeah, well, smoothing, I suppose that's what insurance has always been a big part of. So what about, you've got any other innovations that are in the pipeline? Anything else you're excited about?
Yep, we're doing a lot of work in the third area we spoke about was the emerging risk. And we're focusing here on autonomous vehicles. We've got a couple of interesting inquiries come through as people are building more into particularly last mile type solutions. So not the full expectation of autonomous cars driving us around the street, but perhaps picking up people from the far end of a parking lot in the US and taking them to where they need to be. So that last mile solution and last mile deliveries. Some quite interesting stuff there. And also around the gig economy, there's a lot of work. You mentioned Digital Partners earlier. A lot of their clients are looking at that, changing the model so it's pay per use. If you're a app-based delivery company, you could have tens of thousands of employees on your books, of which a variable number will be working at any time. So using the technology that sits behind the apps to do real-time usage insurance is quite interesting. And obviously, I think, sorry, go on.
No, that's good. And you're quite close to having live pricing and that kind of stuff.
That's the aspiration. I think you need that data set to get live pricing. So it's very easy to use for the motor insurance, where there's huge statistical data sets. A lot of the stuff we're looking at is too new to have that level. But it's more about live use measurement rather than dynamic pricing. It's that, okay, this person has logged onto the app to work for a 2-hour spell, so that's a charge of 2 hours of insurance based on their app usage, all automatically monitored, that sort of product.
Right. Okay. So it's about sort of doing away with all the admin, because of course, if we were trying to do this in the old-fashioned way, it'd be impossible, wouldn't it? It'd be just sort of you'd be raising cover notes and debit notes and credit notes to the point of going completely insane. Obviously, now you can do it all digitally. You'll be fine.
We'll be fine. And also, a lot of it in the past would have been either modelled on historic usage declared by the company, or best estimates of how many people they think they have at any one time. And then you run the risk of being over or under in terms of the amount that they've been charged for their insurance. Here, it's a pure price for use, which is much more accurate and more fair, and frankly can also allow companies to manage their exposure to meet their insurance budget if they choose to do so.
So they can fully price it into what they're doing, because they can price it into the job, absolutely, so they know that they're always covered.
Yep, and they're not necessarily getting a minimum deposit charge up front.
Okay, the autonomous vehicle, just to jump back to that. So why is it, you're talking about last mile, why particularly last mile solutions? Is that because do you think they're likely to be safer? These are the sort of things that, I know there's one at the Terminal 5 of Heathrow. If you go to one of the short stay car parks, you got these kind of bubble cars that will take you back into the terminal from the car park. Are those kind of things? Because is that because they're better risks? Do you think that they're likely because they pretty much go on set routes and they're not as autonomous as something that's purporting to drive you across America while you're on your iPad?
It's pretty much about the stage of development of where the market is. Our colleagues in the US are involved with a lot of the testing programs for the true autonomous vehicles that we expect to see at some stage in the future. But they're very much in the test phase rather than the full launch phase. Whereas, as you said, the slightly more controlled, autonomous within close confines is a little further down the development line. It's live in some areas, so there is a live risk rather than a pure trials risk in a safe trials environment, which is what we're seeing most of with the cars. And
so, just before we wrap up, given your experience so far, obviously you're sort of almost sort of 8-9 months into this project, and through the end of your first quarter, do you think this Syndicate in a Box format, your gut feeling, do you think it's going to be a really big part of Lloyd's future?
I would say it will be a contributor. I'm not sure it will be on its own the biggest thing necessarily, because it is by nature fairly niche and specialist. But I do see it making a valuable contribution to the wider piece of the future of Lloyd's and the blueprints. And I genuinely hope that works and that we see that success. For the 1840 Syndicate, we've very much been the trailblazer with the expectation that others will follow. And a question was asked at the start of this process, well, why Munich Re? They're not very niche, they're not very innovative. Well, we have the ability to do this work and take that risk that perhaps the true beneficiaries later on won't have the budget or the appetite to take that pioneering risk. We're doing it, we're working with Lloyd's, and I genuinely hope that others follow.
Well, I wish you every success, and I hope we'll be sitting in 3 years' time talking about the process of graduating from being a syndicate in a box to going off to being a full syndicate and everything else. And so do keep in touch with all the innovation that you're doing. And thank you so much for your time today, Stuart. I'm sure you must be incredibly busy with all the inquiries that will be coming to your, well, not to your box, but to your virtual box. And good luck with everything. I've really enjoyed talking to you, and I think it's very interesting because there's so much interest in Syndicate in a Box, and so few people actually know what they're talking about when they talk about it, and you absolutely do. So thank you so much for that.
Mark, it's been a pleasure. Thank you.
Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.